How's it going, everybody? I hope you're all having a lovely day. It is time, ladies and gentlemen, to talk about investments and taxes in the same video as we discuss the rules for capital gains and how your dividends are taxed as well as your stock sales are taxed. In this video, I'm going to be covering specifically more along the lines of financial instruments like stocks, bonds, etc. I'm not going to be covering the taxation on the sale of collectibles or real property such as real estate. I'm specifically focusing on dividends and stocks for this video. I've gotten a ton of requests for this video and I've been wanting to do it for a long time, so I finally was able to get around to produce it. Now, as we go through this video, you're going to see a handout on screen, and the handout, the Word document you're seeing, is completely free to download. You're going to find a link to it in the comment section below and in the description section of this video. First, let's talk about why I think you should be excited about capital gains. So when you think of taxable income and you think about tax efficient income, capital gains is pretty high on the list. If you think about it, the most favorable income for income taxes is tax exempt, right? A good example of that would be muni bonds, where you receive tax exempt interest. But other than tax exempt income, which there are very, very few sources of tax exempt income, the next best is income that is taxed at capital gain rates. So capital gain income is huge for your taxes. You can save a tremendous amount of money in taxes by structuring your income to be more capital gain focused. Oh, and speaking of capital gains, if you were fortunate enough to have a capital gain by the end of 2018, well, congratulations. Let's start off by talking about what types of income are subject to capital gains rates. This is really important, and because there's very few types of income there are. The first one is qualified dividends, and the second one is long-term capital gains. But before we talk about long-term dividends and long-term capital gains, let's take a step back and talk about capital gains in general and why they're so awesome. Okay, so depending on your income, which is now it's mainly based on your overall income as you're seeing from the chart on the screen, you might pay $0 on your capital gains, 10%, 15%, or even 20%. 20% is the max. So on capital gain income, okay? And this is huge. This is a huge tax savings because even if you're in the top bracket, or let's say your income is really high and you get taxed on your capital gains at 20%. Well, it sounds like a lot, but it's really not, because when you look over at somebody who's working for wages, those wages they receive, the wages do not get capital gain rate treatment. They're always taxed. That earned income is always taxed at ordinary income rates, which can be a maximum tax bracket now under the new laws of 37%. So compare the maximum 20% rate from capital gains to 37% maximum tax bracket from wages. You can quickly see there's a huge tax advantage to making your income through capital gains. And if you've ever watched an interview from Warren Buffett, sometimes he mentions how the rate of tax he pays on his income is often lower than his secretary's. Well, that's what he's talking about. He's talking about his secretary who earns wages paying ordinary income tax rates versus him who receives a lot of his living through dividends, which is taxed at a much lower rate, at least from a percentage perspective. And obviously, as you guys can see, if your income is low enough, you can pay zero tax on your capital gains and qualified dividends. But with that simple example of a tax rate savings of 17% over the maximum bracket, you can quickly see how fast the tax savings can add up. Now let's talk about capital gain rate treatment and qualified dividends, and then we're going to talk about the treatment for stock sales and stuff like that. So for qualified dividends, what you need to know is a lot of it's just about the holding period, okay? So it's how long you hold the investment. So the longer you hold the investment, the better. Now that you know that there's a huge tax advantage to being taxed at capital gain rates, let's talk about how that applies to qualified dividends. And with dividends, qualified dividends in particular, there's two types of dividends. There's ordinary dividend and there's qualified dividend. Well, the qualified dividend is the one you want. That's where you get the capital gain rate taxes versus that ordinary dividend you get. That's when you're going to be taxed at the same rate as wages or as if you're working for a paycheck at a job. As a simple example, if you buy AT&T stock, when you first get your first dividend payment, you might not have held that stock long enough to get a qualified dividend treatment. So that dividend payment is going to come to you in the form of an ordinary dividend, and you're going to be taxed at ordinary rates. But if you do hold on to that investment long enough, then you're going to get the more favorable capital gain rate treatment, which is what this talks about right here. It says common stock investors must hold the shares for more than 60 days during the 121-day period that starts 60 days before the ex-dividend date. For preferred stockholders, the holding period is more than 90 days during a 181-day period that starts 90 days before the ex-dividend date. Over time, the longer you hold the investment, the more likely you'll start to receive, instead of ordinary dividends, your dividend will eventually become qualified. So there's an incentive to hold on long term to that investment, especially if you're somebody who's investing for dividends. Now, there are certain types of stocks, though, or companies that you can invest in where you can't get the qualified dividend treatment no matter how long you hold it. And a perfect example of that is real estate investment trust. No matter how long you hold on to a real estate investment trust, they're not allowed to send out qualified dividend treatment or qualified dividends. It's always going to come to you. That dividend is always going to come to you in the form of an ordinary dividend. So those are the basic taxation rules for dividends. And now let's move on to capital gains, or when it comes to the sale of stocks. So when we think of stocks, we need to think of the holding periods, right? So because there's a short-term and there's a long-term holding period. In the long-term holding period, we need to hold that investment before we sell it. We need to hold it for more than a year. Notice I did not say exactly 1 year. If you hold the investment for exactly 1 year and then you sell it, you're going to be subject to short-term capital gain rates, which is, you don't want that. You don't, because short-term capital gain rates are taxed at ordinary income rates, just like ordinary dividends and just like wages. You don't want that. That's higher taxation rates. You want to avoid that. So if you're thinking of selling a security, an ETF, a mutual fund, whatever, or stock, and you're close to having it held for more than a year, then by all means, I would probably encourage you to hold on to it for a little bit longer. Hold that stock for 1 year and 1 day, and then sell it, and then you're going to get that good, nice capital gain rate treatment. So it might be the difference between, when you sell that stock, it might be the difference between paying 30% in tax versus 15% in tax just by waiting a little bit longer. So huge tax savings there, as you guys can see. The question I get a lot is, Mike, when do I have to pay taxes on my stocks, sales? When do I have to pay taxes on my dividends? The answer is, it really depends. Just to eliminate any confusion as we progress to talk about taxes in regards to your dividends and taxes in regards to your capital gains, when I'm talking about taxes in this video, just know that I'm talking about if you have your investments in a normal standard brokerage account. In other words, it would mean if your investments were not within a retirement account, such as a traditional IRA or a Roth IRA. If your investments are held within one of those types of accounts, one of those retirement accounts, then when you receive dividends and capital gains, you would not be taxed at all. You would not be paying tax at all until you take a distribution from those accounts. And of course, we know from some of my other videos that if your investments are within a Roth IRA, even when you take a distribution, it's not going to be taxable. But for the purposes of this video, we're strictly talking about taxation of your dividends and capital gains and things like that within a normal taxable brokerage account, a non-retirement account. Now, for most people, their income from, the sale of securities and things like that it's not a lot. And so generally, in reality, when they go to pay the tax on that, they're paying it when they go to file their tax return in the following year. That's for most people. But it's a lot different if you have a really high income, you're an investor who gets a lot in dividends, or you're doing a lot of sales of stocks, you have short-term capital gains, long-term capital gains, etc. Then you might look at making a quarterly estimate payment throughout the year to stay caught up with your taxes. But that's usually for higher income individuals. But just so you know, even most investment platforms, you can tell them to withhold on your dividend payments or from sales of your securities. You can say, okay, well, if I receive, dividend payment of X, please withhold 20% on that for taxes. So that way, what's nice about that, if you want to do it that way, you don't have to, but at least you're paying your taxes in throughout the year, so that you're not surprised when it comes to tax time and when you go to file your taxes and realize, oh shoot, I received $10,000 in stock sales and dividends. No, shoot, now I have to pay hundreds and hundreds of dollars in taxes on this income. So that is one nice thing you can do if you want to do it that way. But like I said, you don't have to. All right, let's talk about stock sales now and taxes for that. So there's two concepts you need to know. The first one is there's recognized gains or losses, and the second one is there's unrecognized gain or loss. So the unrecognized gain or loss is really simple. It just means your position within an investment, whether you have a gain or loss, there's no tax effect over here. So an unrecognized gain or loss has no tax effect, and you guys can read this right here in the handout. The important one for taxes is the recognized gain or loss. That's the one you want to know about. What a lot of people don't understand, or what they need, especially if they're new to investing, is you don't actually recognize gain or loss until the day you sell the investment. Until you sell the investment, no matter if you have a gain of $1 million, it doesn't matter. It's only once you sell it, that's when you have to pay taxes on that money. So just keep that in mind. When you sell it, that's when you recognize it. I put a simple example in the handout, but if I have a gain of $7,000 on my Amazon stock, if I hold on to Amazon, it has no tax effect. I don't have to do anything with it until the day I sell it. Another question I get a lot is, Mike, how are capital gains calculated? It's not too bad. It's not too hard to figure that out. So it's basically you take your fair market value of the stock you sold, or mutual fund or ETF, whatever it was that you sold, minus your cost basis. So your fair market value minus your cost basis. So if you have, let's say you sold a stock, let's say it's Amazon. Let's say you sold Amazon for $2,000, and originally you purchased that stock back in, about over a year ago, and for, let's say, $800. Well, your cost basis now is $800. So purchase price and cost basis are the same thing. But for tax purposes, if you want to learn to speak tax, you want to use the term cost basis. That's what you're going to hear a lot. So to calculate your capital gains now is, let's say we sold our stock for $2,000. Our cost basis was $800. That means we have a capital gain of $1,200. As I mentioned in the example, we held this Amazon stock for more than 1 year. What does that mean? Do we get the short-term treatment or long-term treatment? If you think long-term treatment, you are correct, because we held that investment for more than 1 year before selling it. Okay, so we talked a lot about capital gains on stock sales, but what about if you lose money? People lose money in the stock market. What do we do then? Well, it's not all bad news. If you recognize a loss, there's two things that will happen. One is your capital loss from that investment will help offset other capital gains. And two, part of that loss can be used to offset other income, or it will be carried forward, which we're going to discuss here in just a minute. And I have an example of how a loss would be applied against other capital gains right here, but I'll let you guys read that for yourself. And the next question you might have, are my losses limited from my capital gains? And the answer is yes, they are limited. And so here's an example. So in this example, Chipper incurs a short-term capital loss of $5,000 for the year. How much of the loss can he take? Now, this is from capital gains, right? Or sells the securities and things like that. And it really depends on your filing status. If Chipper is single or married filing separate, he can deduct up to $1,500 in the current tax year from that loss on the sale of his stock. What happens to the rest of it? Well, the rest of it, the other $3,500 of that $5,000 loss would carry forward to a future year. Now, if Chipper's filing status was not single, but if it was married filing joint, he could deduct in that first year up to a $3,000 loss on that $5,000, and the rest remaining would carry forward to the next year or future years. As you guys can see here, the amount of the loss not deducted will carry forward until it's eventually used up. It says the loss carry forward will retain its characteristics as either short-term or long-term. So if you have a long-term loss, it will carry forward as long-term loss. A short-term loss will carry forward as a short-term loss. Moving on, let's talk about the ordering rules just real briefly. So when you sell securities, especially at a loss, then the ordering rules come into play of how that loss is used up. First, the loss is going to reduce any other short-term capital gains, because we're just looking at the short-term capital loss here example, guys. Secondly, but if there's no short-term capital gains, then what? If there's no short-term capital gains, that loss is then applied against net long-term capital gains, taxed at the 28% rate, which would be at the rate collectibles are taxed at. If there's no collectibles, then we moved on down the line to number 3. We would reduce any net long-term gain taxed at 25%, if there's any. Number 4, then we would, if last but not least, if it hasn't been used at that point, we would reduce any net capital gain tax at 20%, 15%, or 0%, if there's any. And of course, if there's nothing to offset it, that loss would just carry forward to a future year. There are ordering rules for long-term capital losses, but I'll let you guys read that for yourself. Big question people have is, what happens to my capital gains if they die, if somebody dies, like a spouse? Well, unfortunately, upon one's passing, all capital gain loss carryovers are lost. But if you're married, there is an exception to that. So let's go down a little bit here. Upon one spouse's passing away, half of their loss is allocating to the surviving spouse and can be carried over to future years. So you at least get to take half the loss from a deceased spouse if there is one to begin with. Whereas if you die single and you lose it, you totally lose it. It just disappears. But by then, you're dead anyway, so who cares? Okay, wash sale rules. What is that? Well, a loss sale occurs when a taxpayer sells a stock at a loss within 30 days before or after the sale and invest in substantially identical stock or securities, acquire substantial identical stock or securities in a fully taxable trade, or enters into a contract or option to acquire substantially identical stock or securities. When you read that, it sounds really confusing, but a more basic example is, let's say I go out and I buy Chevron. And let's say on January 1st, I sell Chevron and I sell it at a loss. But then like 20 days later, I think Chevron is a good investment again. And I go buy Chevron once again. Well, because I'm buying the same identical stock once again within 30 days, or similar stock, I cannot deduct that loss. So I cannot take that loss on my tax return when it comes to tax filing season. And you're going to see that on your 1099-B, which we're going to talk about here in just a second. When you get your official tax form for that tax year, you're going to see that wash sale loss showing up. It's going to have a code W next to it to identify that it is in fact a wash sale. All right, what happens to my stock or securities if they become worthless? It does happen. Worthless securities are treated as though they were sold on the last day of the year. The last day of the year will determine if your loss will be long-term or short-term on these securities. Where do I report capital gains or stock sales on my taxes? Well, let me tell you guys the forms you need to know about. There's a couple forms you need to really understand. One of the first forms to know about is Form 8949, Sales and Other Dispositions of Capital Assets. In my opinion, this is one of the trickiest forms to know about. I'm going to have to make a whole separate video about it because it's not that complicated, but it would take too much time to explain here. The next form to be aware of is Schedule D. Schedule D shows capital gains and losses, and this is where you would go to report not only your short-term capital gains and losses, but your long-term capital gains and losses as well. This is another form where I could do a whole separate video about. Schedule D and Form 8949 interact together. They work with one another, and if you study those two forms closely, you can see how they're related and how information can transfer from one form to the next. From Schedule D, now your final net capital gain numbers, once you add up all your short-term gains or losses, all of your long-term gains and losses, then that information now transfers to, under the new tax forms, to 1040 Schedule 1. Under other income, which is what I'm showing you right here. You can see I've highlighted the line where total net capital gains are reported. Capital gains used to be reported on 1040 page 1, but because of the new tax forms for 2018, now the only place you can find them is 1040 Schedule 1. Since we're talking about capital gains and investments, let's not leave out Schedule B. On Schedule B, you'll see here on the top half of the form is where you would report interest income. On the bottom half of the form is where ordinary dividends would be reported. Now notice it does not say qualified dividends, just ordinary dividends. So what you would do is you would put all your interest income here, all your ordinary dividend income here, and then those totals would transfer to 1040 page 2, as you guys can see here on screen. So we just covered the majority of the forms that relate to capital gains. We talked about Schedule D. We talked about Form 8949. We talked about 1040 Schedule 1. We talked about 1040 page 2. And then, of course, for dividends, interest and dividends is on Schedule B. So we're talking about taxes. Well, where the heck do you get this information for your taxes? Do you have to hunt it down yourself? Do you have to keep track of every penny you buy and sell? Well, the good news is that your brokerage company or the custodian of your account, let's say you're with Robinhood, Ameritrade, or E-Trade, or whatever, Vanguard, Fidelity, when it comes to tax time, usually it's around February, they're going to send you an official statement. It's called a 1099B, or it's a 1099-B. And that statement is going to have all of your investment activity that is important to know for tax reasons. It's meant for taxes. It's not meant to tell you how many shares of this investment you own or that investment. It's meant to report how much interest income you received, how much dividend income you received, whether the dividends were ordinary dividends or qualified dividends, foreign income, capital gains, short-term and long-term. It's going to report all those transactions on that 1099-B, and it usually comes out February of every year, so be looking for it. As we wrap up the video, there's a few final items I want to cover with you guys just real quickly. And let's talk about net investment income tax, because that's a big one. Now, for most people, they're not going to have to pay this. Net investment income tax comes into play when a person has a really high income and they have capital gains as well. Now, this doesn't even come into effect until your income starts to exceed over 200 grand if you're single, if you file your tax return single, or 250,000 if you file married filing joint. So for most people, you're going to completely avoid this. But if you remember earlier in the video, we talked about a 20% max capital gain rate. Well, if you're subject to net investment income taxes, this tax on another 3.8%. So your max capital gain rate goes from 20% up to about 24% now because of these net investment income taxes, unfortunately. But like I said, it doesn't happen until you get a much higher income. When I produce these tax videos, I mainly produce videos around the federal taxation laws because each state is different. So you really need to look carefully at what the capital gain rates rules, if any, apply to the state you live in. California, for example, does not have capital gains rates. Everything is taxed at ordinary income rates, which really sucks, but that's just the way it works. So I don't get any favorable tax treatment here in California, but no surprise there. That's why they have the bear on the flag, right? So I wanted to mention that just so that you know to look out for that on your state income tax return. Last but not least, I've included a link to publication 17 at the bottom of the Word document. You can go here. Even I know it says 2017 returns, ignore that. Many of the rules are exactly the same for 2018 and on when it comes to capital gains and taxation. So you can find more information within this portion of this document. And you can find this information on the IRS website or this link right here. So be sure to check it out if you want to learn more. And I'll probably also link up the link for the instructions to Form 8949, Schedule D, and 1040 page 1, where you can find more information on all of this. The final thing on holding periods I want to mention here, well, as we're talking about long-term and short-term, is that when it comes to investing in taxes, you are much better off going long-term than you are short-term. If you're somebody who's a swing trader, day trader, or if you know people like that, well, when you hold a stock for 1 year or less, you're subject to ordinary income rates. So these people who are doing swing trading and all that kind of investing, who are holding it for a very short period of time, they're paying the maximum tax rates on that income, which is a major bummer. Versus if you just hold your investment for the long term and then you sell it once you've held it for more than a year, then you're only going to be subject to capital gain rates, which, like I said, range from only 0 to 20% in most cases. Much better than the ordinary income rates, which can go as high as 37%. You guys probably know now, or probably realize now from watching my videos, but I really like investing for dividends, and I'm generally a long-term investor. So my focus is to build a portfolio of dividend-producing assets, ETF stocks, and things like that will spin off an income for me in retirement of as much in qualified dividend income as possible, so that when I receive that income, I pay the least amount of tax possible. The least amount. Ladies and gentlemen, that was truly a whirlwind of information. We covered everything from what types of income are subject to capital gain rate treatment, short-term holding periods, long-term holding periods. We talked about the ordering rules. We talked about just a boatload of stuff in this video, where to report on your taxes, etc. So hopefully you guys found this helpful. I look forward to, let me know what you guys think about all this stuff, about these rules. Make sure to download the handout because I spent a lot of time putting this together for you guys, and it's going to be a great reference when you're thinking about your investments and your taxes and things like that. So you can go back and reference this to, stay fresh on all this stuff. If you guys like the video, please do me a solid by smashing that like button. It really helps me out and helps get this video out, promoted to more and more people. If you're new to Money and Life TV, well, welcome to the channel. On this channel, our focus is to help you become fiscally fit, and we do that by teaching finances, investing, and taxes and more on a regular basis. To join our community, all you have to do is hit that red subscribe button and please hit that notification bell icon so you do not miss any of our future uploads. Well, everybody, I think I'm gonna wrap up the video here. I really appreciate you taking time out of your day to be here. I know it's a big commitment, and this was a lot of information to cover, so remember to use the timestamps if you want. I look forward to reading your comments in the comment section. I hope you guys have a wonderful week. Take care of yourself, stay chill, and now take this information and use it to live your life uncaged. I'll see y'all in the next one, guys. Peace.